Hi guys, welcome back to my channel Career Compass Banking Edition, guiding your journey in and beyond banking. Today I will start with the banking knowledge series. Here we'll talk about essential banking terminologies required for competitive exams. The topics that are covered in this series are as follows: central banking and monetary policy, cash reserve ratio and statutory liquidity ratio, NPA, that is non-performing assets, digital banking and payments, RTGS, NEFT and IMPS, cheque, core banking solutions, ECS and NACH. So let's now start with central bank and monetary policy. As you all know, every country has its own central bank. The Central Bank of India is RBI, that's the Reserve Bank of India. This is the monetary authority and the central bank, which is responsible for issuing currency, managing monetary policies of the nation, and regulating the banking system. Please note, this is all about RBI, and there is also a bank in India called Central Bank of India. This conceptually refers to Reserve Bank of India. The central bank of the country is Reserve Bank of India. The key functions of the bank are issuing currency, regulating monetary policy, supervising the banks, and acting as a government banker. And it manages the money supply and interest rate in the country's economy through various monetary policies. The two main monetary policies that RBI uses to control the money supply is the repo rate and the reverse repo rate. So let's now see what is repo rate. Repo rate is a tool to increase the liquidity in the system. It means the rate at which RBI lends money to the commercial banks against the government securities. In the layman language, it is a tool in which it releases more money to the system. So, what is reverse repo rate? Reverse repo rate is a tool to absorb the liquidity from the system. Here, RBI borrows money from the commercial banks by providing government securities. It controls inflation and liquidity by making borrowing costlier or cheaper. When repo rate is higher, borrowing is lesser as it's costlier. When reverse repo rate is higher, banks prefer to park their funds in RBI. That's how the liquidity is being managed. The flow in case of repo rate is from RBI to the banks. In case of reverse repo rate is from banks to RBI. The current repo rate is 5.25% and the current reverse repo rate is 3.35%. The next topic is CRR and SLR. CRR is the cash reserve ratio. Cash reserve ratio is the percentage of commercial banks' total deposits that must be kept as cash reserves with RBI. It's the share of the total deposits that must be kept as liquid cash with RBI. Banks cannot use this money for lending and they earn zero interest out of it. This ensures the solvency, or it's a safety cushion to meet the sudden cash withdrawal demand of the customers from the bank. RBI also controls liquidity by adjusting the ratio to directly manage how much cash can be used for lending. And it also fights inflation. The current CRR is 4.50% of banks' net demand and time liabilities. SLR is the statutory liquidity ratio, and it's a mandatory percentage of deposits that the commercial banks must maintain in safe and liquid assets before they lend money to customers. Unlike CRR, which is physical cash with RBI, SLR assets are held within banks' vaults and earn interest on them. It's a pool of safe sellable assets to pay banks' depositors. It also funds the government and manages the credit flow. The current SLR ratio is 18% of banks' net demand and time liabilities. The next topic is NPA. NPA means non-performing assets. Non-performing assets, the loans or advance where the borrower has stopped making payments for the principal and interest, and there is no income that's being generated out of this asset for more than 90 days. There are three types of NPAs. One is substandard assets, where the loan is in NPA state for a period of 12 months or less. The second one is the doubtful assets. The loan remained NPA for more than 12 months. And the third is the loss assets. This is identified as uncollectible and it's of very less value that it should be written off. This overall reduces the profit of the bank and the lending power and also the economic health of the bank. Let's now talk about digital banking and payments. This encompasses the electronic transfer of money and modern financial management. Instead of cash, transfer happens in mobile apps, cards, or online portals. The core digital payment methods are UPI, which is Unified Payment Interface. This allows real-time bank-to-bank transfers by scanning QR codes. Mobile and digi wallets. This links directly to the debit or the credit cards to pay the transactions. Banking cards. This can be physical or virtual cards or the prepaid cards. Internet and mobile banking. These are the online portals and bank applications for any transactions related to your banking accounts. And then we have RTGS, NEFT and IMPS. IMPS provides instant 24/7 fund transfers with a limit up to 2.5 lakhs. NEFT are the National Electronic Fund Transfers, processes transactions in half-hourly batches rather than real-time, available 24/7 with no upper limit and minimum of ₹1. RTGS is designed for high-value real-time transfers, which are happening real-time on a real-time basis. Now let's see what do you mean by a check. A check is a return order from an account holder to a bank to pay a specific amount of money to a named person or business. The key parties involved include the drawer, the writer, the drawee, which is a bank, and the payee, the receiver. A check is an unconditional order addressed to a banker, signed by the person who has deposited money with the banker, requesting him to pay on demand a certain sum of money only to the order of the certain person or the bearer of the instrument. A check also has a unique 9-digit code to process check automatically. Then we have core banking solutions. It's a hub or a back-end connection for multiple branches of the same bank that allows customers the freedom to access the account transactions in a single safe entity. Core banking operations can include loan management, new accounts, deposits, and withdrawals, among other financial services and many other financial services. The next topic for today is ECS and NACH. ECS is Electronic Clearing Services, is an electronic method used by the banks to handle bulk, repetitive, and periodic financial transactions. It's an older batch processing mechanism by RBI used to transfer funds automatically between a single institution and multiple accounts. ECS includes transactions processed under a NACH operated by NPCI. The two variants of ECS are ECS credit, used by the institutions to distribute a single pool of money to multiple beneficiaries simultaneously. This is used in case of salaries, pensions, or dividends directly into many people's accounts. ECS debit, used by institutions to collect recurring payments from numerous individual accounts like the loan EMIs, insurance premiums, mutual funds, SIPs, etc. The benefits of ECS transactions are the convenience to stop the need of paperwork and bank visits, and on-time payments which helps to pay the bills. NACH or NACH, the National Automated Clearing House. It's a centralized digital payment system created by NPCI to process bulk, recurring, and automated electronic transactions between bank accounts. It is a modern replacement of ECS. It enables seamless mandate-based automated debits and credits across all major Indian banks. This can be set up through online banking, net banking, or official bank platforms. These are some of the very important topics that are required from the banking domain. We'll meet in another knowledge series. Thank you for today.